if we have to transition from the dollar to anything else, I vote for gold because it has already served that purpose in the past and it already sits with a pivotal role in today's monetary system. But it is not going to be an orderly transition. You need to deleverage the existing system, which is based on the dollar. That's why you keep hearing about the de-dollarization, but it never happens. The orderly de-dollarization doesn't exist.
You wrote another article recently entitled The De-Dollarization Fairy Tale, in which you spoke about how the US's massive debt pool provides a home for global foreign exchange reserves. And that's because as the reserve currency, trade is settled in dollars, and then countries with trade surpluses accumulate those dollars, and they need a safe and liquid place to put them to work. And the government debt market in the US serves that purpose. But would you say, what would you say to people who say we should go back to using gold instead as a settlement system? Because that too is liquid. And although it doesn't offer any yield, the real yield on dollars invested in treasuries, is not much to write home about. So what are the arguments for and against that in your view?
I have to say, when you pronounce the titles I write on the Macro Compass, it sounds like I have a thing for catchy titles, the de-dollarization fairy tale. So the thing is, you hear about it every time, this de-dollarization, and it never happens. I mean, come on, how long do we need to wait for, right? That's why I think it's rather a fairy tale. But what's a fairy tale? It's an orderly de-dollarization. That doesn't work simply by the mechanics of it, which you anticipated. But sorry if I am redundant. I want to just make sure the audience understands how the system is built so that we can talk about the transition to gold, which was your original question. So the dollar is an exorbitant privilege. And I didn't say that, but some politician back in the 70s did. Look, it's also quite a responsibility to be the dollar, because what you are basically is you are denominator of basically all trades, transactions, foreign exchange transactions, global trades. You are the denominator and the settling currency of all of these transactions, of almost all of these. What that means is that countries in surplus, as you were saying, Mark, will accumulate your currency. They will sell commodities. They will have dollars. Okay, so these dollars end up on the corporate's balance sheet, on a Brazilian corporate balance sheet that is selling soybeans. It sells the soybeans, it gets dollars. These dollars are sitting in the corporate balance sheet. Corporates deposit these dollars in the banking system. So that means the Brazilian banking system overall will have a bunch of surplus dollars. So now you, as the global reserve currency, have to provide with an outlay to invest these dollars, to keep them safe in the first place. It's not about the returns. It's about parking them in a liquid asset, in a safe and liquid asset. And the treasury market is great for that. It has a deep repo market. It is very, very liquid. It is very, very tradable. And it keeps expanding every year. The fact that the US government debt goes up also means there are more treasuries out there. And think with me, the world grows over time. Brazilian corporates will sell more soybeans. Chinese corporates will sell more goods and services. The world grows, and so does the dollar share of trades and goods and commodities. So that means there are more dollars out there. That means that the market to host these dollars must become bigger. And that's the treasury market. It's not easy to be the dollar. You need to have a government that accommodates and is willing to expand their balance sheet, basically, to accommodate all of that with a liquid and deep market. When I look at competitors, oh my God, man, I mean, where do you want to go? Like, would you want to own Chinese assets or, I don't know what, some Saudi Arabia assets? To be honest, there is not even a market for that, a liquid government bond market in the first place. But then we need to talk about other implications, the rule of law and sanctions and corruption, if you want to talk about Brazil, for instance, and so on and so forth. So an orderly transition from this system either needs another currency or a basket of currencies that can host the same liquid market. And honestly, there is no competitor out there. Even Europe, super fragmented. We don't even have a banking union in Europe. I mean, what are we talking about? Who do we want to fool? In Japan, 60% of the bond market is controlled by the central bank. What deep, what liquid market? This market doesn't trade for 5 days in a row, Mark. So sorry, there are no competitors out there. Let's talk about the transition now, because we don't like maybe a system that is based on a fiat currency. We want it to be based on something else. So gold, coming to your question. How do we transition from that system? Let's think about it. We need to basically have the dollar losing share. We need to have other central banks that accumulate their dollar reserves. And instead of buying dollar assets with these dollar reserves, they sell dollars and they buy more gold. And so the system becomes more gold-centric. On the asset side of the central banks of China, of Brazil, of Russia, of Europe, you'll find more gold and less treasury assets. That's how the transition begins. We are seeing some signs of that. Central banks have been buying a lot of gold recently. I think gold is the most likely candidate to replace the system because it has already served that purpose in the past, Mark. It already sits in very large sizes on all government and central banks' balance sheet in the world. So it's already there to be used as an asset. Gold, though, first of all, you can't expand the supply of gold. Let's think about that. This is not a market anymore where you can produce more gold to accommodate more reserves. You can't do that anymore. That's over. It's a system which is not elastic. By definition, when you pin anything to gold, you're going back to fundamentals, Mark. Forget about leverage. Forget about credit. It doesn't work. You can build it up. You can financial engineer a system based on credit with gold as an underlying asset that pins it, but it's financial engineering. The moment you want to turn this new fiat currency into gold, at some point, you're going to realize there is too much fiat currency and there is not enough gold. Gold is not elastic. So can we have a system based on gold? Yes, we can. But then we need to go back to fundamentals. And the fundamentals of our economies are not looking as good as they were in the 70s, guys, or in the 60s, or in the 50s, or in the 80s. We are looking at a system that is growing much less organically. Still, if we have to transition from the dollar to anything else, I vote for gold because it has already served that purpose in the past and it already sits with a pivotal role in today's monetary system, but it is not going to be an orderly transition. You need to deleverage the existing system, which is based on the dollar. There are $12 trillion of debt issued in dollars by entities not sitting within the United States. I need to repeat this. $12 trillion of debt denominated in dollars from China, Brazil, Russia, India, Europe. They don't have access to dollar liquidity. So the moment you want to shrink their access to the dollar, the moment that you tell Brazil you're not going to sell soybeans in dollars anymore, then how are they going to pay their dollar debt, Mark? You need to basically either default or deleverage on the system. I am saying important words here. Deleverage a $12 trillion debt system or default on it outright. It's not an orderly transition. That's why you keep hearing about the de-dollarization, but it never happens. The orderly de-dollarization doesn't exist.
I know you're pressed for time, so let's wrap up our conversation by quickly talking a little bit about portfolio allocation in the current macro environment. And since this show is called Resource Talks, and our listeners are disproportionately interested in mining stocks, would you give us your prognosis on where you see commodities going? Because, you know, of course, there are commodities known for being cyclical, like copper or nickel or steel. Are there any commodities that you think could do well in a global recession? Are you getting any exposure to commodities right now, or are you staying away?
So industrial commodities and a recession don't go well with each other. I want to make sure the audience understand that the commodity super cycle theory that was very, very popular in 2021 is not over. It's not like it doesn't exist or it was proven wrong, but most people confuse cycles with trends. A commodity super cycle is something that unfolds over 5 to 10 years minimum. So it takes time. It's a macro trend. It's a long-term trend. Cycles like the macro cycle, the growth cycle, the recession, those can hit in 6 to 9 months. So that means your thesis can be still right, but your cycle can go pretty much against your long-term thesis. So don't overlay cycles and trends. Think about your time horizon. Think about what you're trying to do. In this particular cycle, Mark, I am not a big fan of industrial commodities. I'm not a big fan of crude oil. We are seeing that even as you try to cut the supply, like OPEC did with oil, for example, a few weeks ago, it doesn't work because the demand is not there. So a temporary cut of supply doesn't really solve a cyclical demand issue. The economy is slowing down. World trade is slowing down. So we are in a phase where demand will go down. That doesn't help cyclical commodities like oil or industrial commodities in this particular cycle. If I need to get exposure to commodities, then obviously precious metals are the highest candidate up on the list right now. I mean, gold is already above $2,000 per ounce. It's trading pretty strong. It has this tailwind of central banks that are an inelastic buyer. They just purchase gold regularly because they want to change the allocation they have to their assets. They don't want euros, dollars. They still want them. They want more gold in percentage. So they will allocate a bit more to gold over time. It has this inelastic purchase, flow behind it. And in the macro cycle, amongst the commodities, gold is the one that in a recession looks the best. Notice, it doesn't mean it always performs well in a recession. And why? If it's a deleveraging recession, if some credit stress is happening, then as you deleverage, you need to basically pay off your debt. Deleveraging means paying off your debt. To pay off your debt, you need to liquidate your assets. You need assets, you need cash. So you sell your assets, you raise cash, you liquidate your debt. That's what you do, right? You pay back your debt. Gold is an asset. In our financialized economy, gold is an asset class. It's a financial instrument, which means, as we have seen in 2020, funnily enough, gold sometimes in deleveraging episodes tends to temporarily suffer. It gets caught in the deleveraging episode. People sell gold to raise the dollars to pay back their dollar debt. Honestly, I'm hoping that happens, because if that happens, then it's a really good opportunity to buy, because the world is telling you something is going wrong somewhere, and gold is getting sold, not because it doesn't protect you against that problem, but because it's a financial asset. It's caught in the crossheads, basically, the crosshairs of this problem. So that would be an amazing opportunity to buy gold. Nevertheless, I think it's an asset that it's good to accumulate over time, given the macro cycle. And amongst the commodities, it is definitely my preferred asset to have.
All right, that should do it for this first part of this conversation, or at least for this specific topic. In the rest of the interview, Mark and Alf talked about the debt problem that the U.S. is facing, as well as how that might end. They talked about the upcoming recession that Alf is expecting and how bad that could get. They also talked about what the Fed could or could not do to help that narrative play out in sort of the most favorable way possible, I guess, which in Alf's opinion was means that the Fed will have to stop hiking rates. And they also talked about gold, as you saw, the gold-backed currency, de-dollarization, and stuff like that. So Alf thinks that rates will have to drop soon. Now, I might be uploading more clips from this conversation if there is enough demand for it, I guess. But if you want to listen to the full podcast for free, you can do that on resourcetalks.com under the tab Interviews, where the unedited conversations get published in advance to them being uploaded on YouTube, and where you also get the chance to, submit questions for the guests that we have on here. We announce them in advance. We ask for people to forward their own questions, as well as you can just chat to other sort of like-minded people about natural resources, macro, and whatever else. Again, that's resourcetalks.com. And that said, thank you for joining me on my learning journey. And until the algorithm gods connect us again, stay safe out there.